Everyone says just follow the trend and you'll make money. So why do most trend traders still lose? This video exposes what nobody warns you about when trading trends. Trend following looks safe, it looks smart, it feels like the easy way in trading. But here's the truth. Trends trap more traders than they help. In this video, I'll break down the 5 biggest mistakes traders make when following market trends, mistakes that quietly drain accounts, build fake confidence, and make losing feel normal. You'll see why trend traders lose, how your mind works against you, and what smart traders do differently to survive and grow. Stay till the end, because mistake number 5 is the one almost everyone ignores, and it's usually the account killer. When people talk about trend following, they usually make it sound like the safest thing in trading. Just wait for the trend, hop in, and ride it. Simple, clean, almost too easy. And that's exactly where the problem starts. Because the moment a trend becomes obvious to everyone, that's usually the moment it becomes dangerous. Beginners don't know this yet. Intermediate traders forget it when emotions kick in. And even experienced traders fall for it when the market starts moving fast and loud. Here's how it usually plays out. Price has already been moving in one direction for a while. Candles look strong. Pullbacks are shallow. Twitter, YouTube, and Discord are all saying the same thing. This trend is solid. This move is just getting started. And in that moment, your brain flips a switch. It feels safe. It feels confirmed. It feels like you're finally not guessing anymore. But what you're really doing is chasing. Chasing doesn't feel reckless. That's why it's so dangerous. It feels logical. You're not buying random levels. You're not fighting the market. You're following strength. And yet, this is where most trend traders quietly bleed. When you enter a trend after it's already obvious, you're accepting the worst possible trade location. Your stop has to be wide because price has already moved far. Your target is unclear because you're late. And the market doesn't owe you continuation just because the trend looks strong. Professionals understand something most retail traders don't. Trends don't move because they're obvious. They move because of imbalance. And once that imbalance gets fully recognized, the easy money is already gone. Beginners usually chase because they're afraid of missing out. They watch price run without them, and every candle feels like an insult. So when they finally click buy or sell, it's not based on a plan, it's based on relief that they're finally in. And that relief almost always turns into stress the moment price pulls back even a little. Intermediate traders chase for a different reason. They think experience protects them. They tell themselves, this isn't FOMO, this is confirmation. But confirmation is often just delayed fear. Fear of being wrong earlier, fear of missing another move. So they wait for everything to line up, and by the time it does, the trade is already crowded. Even advanced traders can fall into this trap, especially during strong trends. When volatility expands and price moves fast, it messes with your timing. You start telling yourself that pullbacks won't come this time, that the market has changed, that this trend is different. And that's when discipline slips just enough to cause damage. The market has a cruel sense of humor. It loves rewarding patience early and punishing confidence late. Strong trends don't end when traders are scared. They end when traders feel comfortable. Chasing also messes with your psychology in a subtle way. When you enter late, every pullback feels personal. You're already in drawdown faster than expected. So instead of managing the trade objectively, you start managing your emotions. You widen stops, you hesitate to exit, or you cut winners too early because you don't trust the position. This is why traders say, I was right about the trend, but still lost money. Direction was never the issue. Timing was. Real trend trading isn't about jumping in once something looks good. It's about positioning before it looks obvious, or waiting for price to come back to you when everyone else is chasing highs or lows. That patience feels boring, it feels slow, and it feels uncomfortable because it forces you to sit out moves. But it also protects your capital and your mindset. If you find yourself entering trades because price is moving fast, because everyone is talking about it, or because you don't want to miss the move, that's not strategy, that's pressure, and pressure is not a trading edge. The hardest part is that chasing often works just enough to keep you doing it. You'll catch a few winners, you'll feel validated, and then one reversal will wipe out multiple trades. That's why this mistake survives for so long. It doesn't fail loudly, it fails slowly. And this is where things get even more confusing, because after chasing a trend and getting punished, most traders don't realize what actually happened. They think the trend reversed. They think the market trapped them. But many times, the trend didn't even end, it just pulled back. And that leads directly into the next mistake traders make, confusing normal pullbacks with full trend reversals and reacting emotionally instead of strategically when price finally breathes. After chasing a trend and finally getting in, this is where most traders get shaken out. Not by a full reversal, not by anything dramatic, just by a normal pullback that feels way bigger in your head than it actually is on the chart. This mistake hits traders at every level, and that's what makes it so sneaky. Beginners panic because they don't know what's normal. Intermediate traders overanalyze and second-guess themselves. Even experienced traders sometimes react too fast when price doesn't do what they expected right away. Here's the truth most people don't want to hear. Trends do not move in straight lines. They never have, and they never will. Every trend needs pauses, it needs pullbacks, it needs areas where price cools off, traps late traders, and reloads liquidity. That's how markets breathe. But when you're inside a trade, logic takes a back seat. The moment price moves against you, even slightly, your mind starts filling in the worst-case scenario. You start thinking, this doesn't look good anymore. One candle turns red, then another, and suddenly you're convinced the whole trend is over. This is where confusion kicks in. A pullback feels like a reversal because it attacks your confidence, not your analysis. Especially if you entered late, every pullback feels amplified. You didn't have room for price to breathe, so now it feels like the market is coming straight for you. Beginners usually make this mistake by exiting too early. They get into a trend, price pulls back, and they panic out at the worst spot. Then, 5 minutes later, price continues in the original direction without them. That's when frustration sets in. They feel like the market is messing with them, when in reality, they just didn't understand structure. Intermediate traders fall into a different trap. They try to predict the reversal. They see a pullback and think, maybe this is the top. So instead of managing the trade they're already in, they start flipping bias. They exit longs and jump into shorts, right into the teeth of a continuation move. Advanced traders know pullbacks are normal, but they still mess this up when emotion creeps in. Maybe they've been on a losing streak. Maybe they're overexposed. So when price pulls back harder than expected, they override their plan and cut the trade early just to feel safe again. The market doesn't care about your comfort level. It moves based on liquidity, not feelings. One of the biggest reasons traders confuse pullbacks with reversals is because they focus too much on candles and not enough on context. A few strong opposite candles can look scary, but without a break in structure, without real displacement against the trend, nothing has actually changed. Reversals take effort. They don't just happen because price pauses. They need time, failed continuations, and clear signs that the dominant side is losing control. Pullbacks, on the other hand, are often fast, emotional, and designed to make traders doubt themselves. This is where patience becomes a weapon. If you understand that pullbacks are part of the trend, you stop reacting to every little move. You stop staring at every tick. You let price do its thing instead of trying to control it. Another reason this mistake is so common is because traders don't define invalidation before entering the trade. They don't know exactly what would prove them wrong. So when price pulls back, they're forced to make decisions in real time, under pressure, and pressure leads to bad calls. Professionals define failure before they define profit. They know exactly where the trend breaks and where it's still intact. Everything in between is just noise. Social media makes this worse. You'll see someone calling a top or bottom every time price pulls back. That noise plants doubt in your head, even if your trade was solid. You start questioning yourself, checking charts you don't need, and looking for reasons to exit. This is how traders talk themselves out of good trades. But here's the flip side, and this is important. Not every pullback should be ignored. Blindly holding through everything is just as dangerous. The skill is knowing the difference between a healthy pause and a real change in market behavior. That skill comes from experience, screen time, and emotional control, not from indicators screaming buy or sell. Most traders don't lose because they can't read charts. They lose because they can't sit through discomfort. Pullbacks create discomfort by design. They exist to test conviction and shake out weak hands. And if you keep mistaking pullbacks for reversals, you'll always be late. Late to enter, late to exit, and late to realize what went wrong. Now, after traders survive chasing and pullbacks, something else starts creeping in. Confidence, sometimes too much of it, especially when trends feel strong and trades start working back to back. And that leads us straight into the next mistake, overconfidence during strong trends, when traders start thinking they finally cracked the code. That's where things really start to get dangerous. After surviving the chop, sitting through pullbacks, and finally watching a trend move in your favor, something dangerous starts to happen. It's not fear anymore. It's confidence, and not the healthy kind, the kind that sneaks up on you and quietly loosens your rules. Strong trends are seductive. They make trading feel easy. Trades hit targets faster, pullbacks feel shallow, every entry seems to work, and your brain starts telling a new story. Maybe I've finally figured this out. Maybe this market just fits my style. Maybe I can push it a little. That's where overconfidence is born. This mistake doesn't hit beginners right away. Beginners are usually too scared. It hits traders once they get a taste of success. Intermediate traders fall into it the hardest because they have enough wins to trust themselves, but not enough scars to stay cautious. Even advanced traders aren't immune, especially during clean, strong trends that move without much resistance. Overconfidence shows up in small ways at first. You stop waiting for perfect entries. You skip your full analysis because it's obviously trending. You increase your position size just a bit because this one feels solid. None of these moves feel reckless in the moment. They feel earned. That's the trap. The market doesn't reward confidence, it rewards discipline. And strong trends are the exact environment where discipline quietly breaks down. One of the biggest lies traders tell themselves during strong trends is that the market has changed. They think volatility will stay low. They think pullbacks will stay shallow. They think the move will just keep going because it's been going. But trends don't end when traders are scared. They end when traders get comfortable. When confidence goes up, reaction time slows down. You stop respecting risk because recent wins make losses feel unlikely. You hold trades longer than planned. You hesitate to exit when price shows signs of trouble. And when the market finally snaps back, it snaps hard. Beginners experience this as confusion. They don't understand why the same setup that worked 5 times in a row suddenly failed big. Intermediate traders experience it as disbelief. They start saying things like, "This move makes no sense," or "The market just reversed out of nowhere." Advanced traders experience it as frustration because they know better but still got caught leaning too heavy. Overconfidence also messes with trade frequency. When trends are strong, traders start trading more. They take marginal setups. They enter mid-move. They stack positions. They feel like they need to squeeze everything out of the trend before it ends. That urgency creates sloppiness, and the market loves sloppy. Another danger of overconfidence is that it changes how traders respond to losses. Instead of taking a loss as part of the game, confident traders take it personally. They try to get it back fast. They re-enter without confirmation. They double down because the trend should continue. That's how one loss turns into a mess. Strong trends give traders the illusion of control. It feels like you're aligned with the market, like you're on the right side of history. But alignment isn't ownership. The market doesn't belong to you just because you caught a few moves. Professional traders treat strong trends with more respect, not less. They actually become more cautious when things are going well. They know that easy money conditions don't last. They tighten execution, not rules. They protect profits instead of chasing more. This is the part most people don't talk about. The better you're doing, the more dangerous your own mindset becomes. Success lowers your guard. It makes you forget how fast things can flip. And when the flip happens, it exposes something deeper. Overconfidence usually hides another mistake underneath, ignoring where you are in the bigger picture. Because when traders feel invincible, they stop zooming out. They stop asking where price is on the higher time frame. They stop respecting major levels. They only see momentum in front of them, not the wall ahead. And that brings us straight into the next problem, ignoring market context and higher time frames, especially when trends feel strong and unstoppable. That's where overconfidence meets reality, and where a lot of trend traders give back everything they just made. Once confidence kicks in, traders start doing something subtle but deadly. They stop zooming out. When a trend is strong on the chart you're trading, it feels like that's all that matters. Price is moving, trades are working, momentum is clean. So why bother checking anything else, right? That mindset is exactly how traders walk straight into higher time frame trouble without even realizing it. Ignoring market context doesn't feel like a mistake while you're doing it. It feels efficient. It feels focused. You tell yourself you're not overcomplicating things. But what you're really doing is trading blind to the bigger forces that actually control the market. Beginners usually ignore higher time frames because they don't fully understand them yet. They see price going up on their screen and assume that means buy. They don't realize that the move they're trading could be a small bounce inside a much larger downtrend. So when price suddenly slams back down, it feels random and unfair. Advanced traders ignore context for a different reason. They know higher time frames matter, but when things are moving fast, they convince themselves it's not necessary this time. They think, I'll check it later, or momentum will push through. That's how trades that looked perfect on a lower time frame get crushed by levels the trader never even looked at. Advanced traders usually understand context, but overconfidence makes them lazy. When trends are paying, they start trusting momentum more than structure. They rely on experience instead of confirmation, and that's when even seasoned traders get blindsided. Here's the core truth. Trends don't exist in isolation. Every trend you see is happening inside a larger framework. Support, resistance, supply, demand, consolidation zones, previous highs and lows, all of that still matters even when price is moving fast. A trend that looks clean on a small time frame can be running straight into a major wall on a higher one, and the market doesn't care how strong momentum feels when it hits that wall. This is why traders often say the trend was perfect and then it just reversed. In reality, the reversal wasn't random at all. It was a reaction to context they ignored. Another problem with ignoring higher time frames is that it messes with expectations. When you only see the market up close, every move feels bigger than it is. A normal retracement on a higher time frame can look like a full collapse on a lower one. That mismatch creates emotional decisions. Context keeps you grounded. It tells you whether you're trading with the bigger flow or just catching a temporary wave. It helps you understand whether a pullback is likely to hold or fail. Without it, you're guessing. Market context also helps you choose better trades, not just manage them. It filters out low-quality setups. It stops you from taking trades that look good technically but make no sense strategically. Professionals don't start analysis from the entry time frame. They start from the outside and work in. They want to know where price has been, where it's likely to react, and who's in control. Only then do they look for entries. Retail traders usually do the opposite. They find an entry first and then look for reasons to justify it. That's backwards. Ignoring context also creates false confidence. You think you're trading the trend, but you're actually trading against higher time frame pressure. That's why some trades feel heavy from the start. They don't flow, they grind, they stress you out. That's not bad luck. That's friction from trading in the wrong location. And this mistake becomes even more dangerous when traders combine it with bigger position sizes. When you're confident, when the trend looks strong, and when you're ignoring context, risk quietly balloons. You don't realize how exposed you are until price snaps back hard. This is where accounts take real damage, not from one bad trade, but from being on the wrong side of the bigger picture while risking too much. Market context isn't about predicting the future. It's about understanding where you are in the story. Are you early in a move? Are you late? Are you trading continuation or are you trading into exhaustion? If you don't know that, you're gambling. And now we arrive at the final mistake in this sequence, the one that ties everything together and amplifies all the others. Because once traders ignore context and feel confident, they usually do one last thing that seals the deal. They risk more because the trend feels strong. That's the mistake that turns normal losses into account killers. And that's exactly what we're going to break down next. After ignoring context, after trusting momentum a little too much, this is usually the final move traders make before things go sideways. They don't change their strategy. They don't even change their entries. They change their risk. And it almost always starts with a sentence that sounds reasonable. The trend is strong. When traders say that, what they really mean is, this feels safe. And the moment a trade feels safe, risk quietly creeps up. Beginners do this without even realizing it. They see trades working and think risking more is how you grow faster. They assume strong trends reduce risk, so increasing position size feels logical. They don't understand yet that risk isn't about how good something looks, it's about how wrong it can go. Intermediate traders usually justify it. They'll tell themselves they're optimizing. They'll say things like, I'm more confident in this setup, or this one deserves more size. But confidence is not a metric, it's a feeling, and feelings don't protect capital. Advanced traders know better, but they still fall into this trap when conditions feel perfect. Clean trend, clear structure, momentum everywhere. They've seen this movie before, and it worked last time, so they press a little harder than usual. Not reckless, just enough to matter. That's what makes this mistake so deadly. It doesn't feel like gambling, it feels like leveling up. The market doesn't reward traders for being brave, it rewards them for being consistent. Strong trends don't eliminate risk, they hide it. Volatility compresses, pullbacks get smaller, and losses feel unlikely. But when strong trends end, they don't end gently. They end fast. Sharp reversals, deep pullbacks, sudden volatility spikes. And when you're oversized, those moves hit different. What would have been a normal loss becomes a gut punch. What would have been manageable becomes emotional. This is how accounts get wrecked. Not from being wrong, but from being wrong while risking too much. There's also a psychological trap here that most traders don't notice. When you increase risk during strong trends, you tie your confidence to market conditions. As long as the trend works, you feel smart. When it doesn't, self-doubt hits hard. That emotional swing leads to revenge trades, hesitation, or complete shutdown. Risk should never change based on how good a trade feels. That's backwards. Professionals set risk first, then look for trades that fit inside it. They don't stretch risk to match opportunity. They wait for opportunity to fit their risk. Another reason traders increase size in strong trends is impatience. They feel like time is limited, like they need to extract as much money as possible before the trend ends. That urgency kills objectivity. You start forcing trades instead of letting them come to you. And the worst part? The market often punishes increased risk immediately, not later, right after you size up. One deep pullback, one failed breakout, one news spike, and suddenly weeks of gains are gone. That's when traders say, I was right about the direction, but still lost money. Direction doesn't matter if risk is wrong. This mistake also connects back to everything we talked about earlier. Chasing trends puts you in bad locations. Misreading pullbacks makes you hold too long or exit too fast. Overconfidence loosens your rules. Ignoring context blinds you to danger. Increasing risk ties all of it together into one big problem. Professionals don't increase risk in strong trends. If anything, they often reduce it. They protect capital. They know trends are gifts, not guarantees. They also understand that the goal isn't to make the most money in one move. It's to stay in the game long enough for probabilities to play out over time. If your biggest losses happen during your best trading periods, this mistake is probably why. Now here's the part most people don't expect. Fixing this mistake doesn't require a new strategy. It requires a different mindset about what trend following actually is. Because the traders who survive long-term don't follow trends the way retail traders do. They approach them with structure, patience, and restraint. And that's exactly what we're going to talk about next. How professionals actually follow trends differently, and why their version of trend following looks boring, slow, and unbelievably effective. That shift in thinking is what separates traders who blow up from traders who stay profitable. After hearing all the mistakes, most traders start thinking the same thing. So how do the pros actually do it? Because clearly, professional traders aren't chasing, panicking, overtrading, or blowing up accounts every time a trend shows up. And the difference isn't some secret indicator or insider info. It's how they think about trends in the first place. For professionals, a trend isn't an invitation to go all in. It's a condition. It's context. It's just one piece of a much bigger puzzle. Retail traders usually see a trend and think, this is my chance. Professionals see a trend and think, how do I manage this without messing it up? That mindset shift alone changes everything. Pros don't chase strong moves. If price runs without them, they let it go. No FOMO, no panic. They know another setup will always come. Missing a trade doesn't hurt them because their identity isn't tied to being right all the time. Instead of buying strength, professionals look for balance. They want pullbacks that make sense. They want areas where risk is defined and invalidation is clear. If they can't define where they're wrong before entering, they don't enter at all. Another big difference is how pros treat time. Retail traders rush. They want action now. Professionals are patient to the point where it almost looks boring. They'll wait hours, days, sometimes weeks for price to come into their zone. That patience isn't passive, it's intentional. Professionals also respect the fact that trends are temporary. They don't marry them. They don't assume continuation. Every trade is treated as a probability, not a promise. That's why they're quick to exit when conditions change and calm when trades fail. One thing that shocks most retail traders is how small professional risk usually is. Even during strong trends, pros aren't swinging for the fences. They keep position sizes controlled. They'd rather survive 10 bad trades than try to hit one big home run. That's because professionals think in series, not in single trades. They don't care if this trade wins or loses. They care about what happens after 100 trades. That long-term view makes them emotionally stable, which is a massive edge. Another key difference is how pros use confirmation. Retail traders wait for everything to line up, which often means entering late. Professionals don't need perfection. They need alignment. They understand that waiting for certainty usually means paying a higher price. They also don't stare at screens all day hoping something happens. They plan. They mark levels. They know ahead of time where they want to act. When price gets there, they execute. When it doesn't, they move on with their day. This is why professional trend following looks boring on the outside. No constant trades, no big emotional swings, no revenge trading, just calm execution and strict rules. Pros also separate confidence from ego. They trust their process, not their feelings. When a trade works, they don't feel invincible. When it fails, they don't feel stupid. It's just data. One of the most underrated things professionals do is they step away. When markets get wild or trends get too extended, they reduce activity. They don't force trades just because volatility is high. Sometimes the smartest trade is no trade. And here's the part most people don't want to accept. Professionals are okay with making less money in exchange for more consistency. They don't try to catch every move. They don't care about bragging rights. They care about staying profitable year after year. That's why their version of trend following feels slow. It feels disciplined. It feels almost boring. But boring is sustainable. Excitement is expensive. Professionals also know that psychology is the real battlefield. Charts matter, but emotions matter more. That's why they build systems that reduce decision-making in the moment. The less they have to think under pressure, the better they perform. They also review constantly, not to beat themselves up, but to stay sharp. They study their mistakes. They track their behavior. They're always refining, but never desperate. And this is where everything starts to come together. Once you understand how pros think about trends, the next step is learning how to apply that thinking in real time. Because knowing all this doesn't help if you can't control yourself in the moment. That's why the next part is crucial. A simple mental checklist you can run through before trading any trend. Nothing fancy, nothing complicated. Just a way to slow down, stay grounded, and avoid repeating the same mistakes. That checklist is what turns knowledge into discipline. After understanding how professionals actually follow trends, most traders ask the same question. Okay, but what do I do right before I click buy or sell? Because knowing the right mindset doesn't help if emotions hijack you in the moment. That's where a mental checklist comes in. Not something complicated, not a 10-step system, just a few internal questions that slow you down enough to protect you from yourself. This checklist isn't about finding perfect trades, it's about avoiding bad ones. The first thing professionals do before any trend trade is check their motivation. They ask themselves why they're about to enter, not in a philosophical way, but in a real one. Is this trade coming from patience or pressure? From planning or panic? If the answer is fear of missing out, that trade is already compromised. Then they check location, not just direction. A trend can be real and still be a bad trade if you're entering at the wrong spot. Pros ask themselves if price is coming to them or if they're chasing price. If you're reaching for entries instead of waiting, that's a red flag. Next comes risk, and this is huge. Before thinking about profit, professionals define exactly where they're wrong. Not where they hope price won't go, but where the idea is invalid. If you can't clearly explain why the trade would be wrong, you shouldn't be in it. That single question filters out more bad trades than any indicator ever will. Another quiet but powerful check is emotional state. Pros pay attention to how they feel before entering. Are they calm, focused, or annoyed, bored, or trying to make something happen? Emotions don't just affect outcomes, they affect decisions. And decisions made in the wrong emotional state usually cost money. Time also matters. Professionals don't rush entries just because they're staring at the chart. If price isn't at a level that makes sense, they wait. They don't force timing. They don't need action to feel productive. Waiting is part of the job. They also ask themselves if the trade fits the bigger picture. Not every trend is worth trading. Is this aligned with higher time frame direction? Is price near a major level? Are they trading into strength or into exhaustion? Context keeps trades grounded in reality. Another underrated part of the checklist is size. Professionals confirm position size before entering, not after. They don't adjust size based on how good the trade feels. They adjust it based on predefined rules. If the size feels uncomfortable, that's usually a sign it's too big. They also think ahead. What will they do if price moves against them? What if it goes sideways? What if it hits target fast? Pros don't wing it. They visualize responses, so they're not making emotional decisions in real time. And here's a big one. They ask themselves if they'd still take this trade if they hadn't just watched the last few candles. In other words, are they reacting to recent movement or responding to a plan? That question alone can snap you out of impulse mode. This checklist doesn't eliminate losses, nothing does, but it dramatically reduces regret. Because even when a trade fails, you know you followed your process. That keeps your confidence intact and your mind clear for the next opportunity. Beginners benefit from this checklist because it creates structure. Intermediate traders benefit because it reduces overtrading. Advanced traders benefit because it keeps ego in check. It scales with experience. The goal isn't perfection. The goal is consistency. Doing the same smart thing over and over, even when emotions try to pull you off track. When traders skip this mental check, they don't usually realize it right away. The damage shows up later, in tilted trades, in revenge trades, in blown weeks after one bad decision. This checklist is a pause button. It forces you to slow down in a fast market, and slowing down is often the real edge. Once you start using this mental filter, something interesting happens. You trade less, but better. You feel calmer, you stop chasing, and you start seeing the market more clearly. And that brings us to the final reality most traders don't want to face. Even with the right mindset, the right checklist, and the right approach, most trend traders still lose money. Not because trends don't work, but because they ignore everything we just talked about. That final reality check is what we need to address next. At this point, a lot of traders feel two things at the same time: clarity and discomfort. Clarity because the mistakes finally make sense. Discomfort because they see themselves in them. This is the part most trading videos avoid. Not strategies, not setups. The real reason why, even with trends, even with all the knowledge in the world, most traders still lose money. And it's not because trend following doesn't work. It does. Institutions use it. Funds use it. Professionals make a living with it. The problem isn't the method, it's the behavior. Most trend traders don't actually follow trends. They react to them. They chase after moves once they look obvious. They panic during normal pullbacks. They get cocky during strong runs. They ignore the bigger picture. And then they size up right when risk is highest. Each mistake alone might not kill an account, but stacked together, they're lethal. The market doesn't wipe traders out in one dramatic moment. It drains them slowly. A bad entry here, a premature exit there. One oversized trade that undoes weeks of progress. And because it happens over time, traders don't always connect the dots. Beginners usually think losing is part of learning, so they accept bad habits early. Intermediate traders think they're almost there, so they keep pushing without fixing the core issues. Advanced traders know better, but sometimes ego convinces them they're the exception. The market treats all of them the same. Another harsh truth is that most traders want certainty in an environment that runs on probability. Trends feel safe because they look directional, but direction alone doesn't guarantee profit. Execution does. Traders also underestimate how much psychology matters. They focus on charts, indicators, and entries, but ignore how emotions shape every decision. Fear, greed, impatience, and overconfidence don't disappear just because a trend exists. In fact, trends amplify them. Most traders also confuse activity with progress. They feel like trading more means learning more. But without structure and reflection, repetition just reinforces mistakes. That's why many traders trade for years and still struggle. There's also a comfort trap. Trend following is popular because it sounds simple. Trade with the trend feels easier than dealing with nuance. But simplicity doesn't mean easy, and when traders realize that, many quit instead of adapting. The final reality is this: the market doesn't care about effort. It doesn't care how badly you want it. It only responds to discipline, consistency, and respect for risk. The traders who survive aren't the smartest. They're the most controlled. They don't try to beat the market. They try not to beat themselves. If you take anything from this video, it should be this. Losing traders don't lack information. They lack structure. They lack patience. And they lack emotional control when it matters most. The good news is that all of this is fixable. Not overnight, not with one strategy, but with awareness and intentional change. And that's where we end this journey, not with another technique, but with a mindset shift. In the final message, we'll tie everything together and talk about what really separates traders who stay stuck from traders who finally move forward. That's where this all leads. Before we wrap this up, I want you to understand one simple thing. Trading trends isn't about being right more often. It's about making fewer bad decisions when the market tries to mess with your head. Every mistake we talked about in this video comes down to discipline, patience, and knowing yourself under pressure. If you're a beginner, don't feel behind. Most traders never even realize why they're losing. You do now. If you're intermediate, this is your checkpoint. This is where you stop repeating the same cycles and start tightening your process. And if you're experienced, this is your reminder that the market doesn't reward ego. It rewards control. You don't need more indicators. You don't need to trade more. You need to trade smarter, slower, and with intention. If this video helped you see trend trading in a new way, hit the like button. It tells the algorithm to push this message to traders who need it. Subscribe if you want more real, no BS trading psychology content like this, and drop a comment saying discipline if you're serious about fixing your trading from the inside out. This channel is about building traders who last, and if you stay focused, patient, and disciplined, the results will come.